to Money Minutes. I'm Zak Gardezy, a certified financial planner, private wealth advisor, and the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also the host of Money Minutes, a weekly update series where I talk about the latest market headlines and my outlook. So today we're going to focus on earnings season, and then going to spend a few minutes talking about high yield savings rates, money market funds, and what the Fed's rate cuts have done, and what investors should consider doing next. So let's get right into it. So earnings season is here, and we're about to spend the next 6 weeks or so hearing from executives at publicly traded companies. We'll learn about how certain companies, sectors, and the overall economy performed in the previous quarter. And this information directly impacts the market and will shape at least the near-term outlook, that investors have on the overall market. So the big banks are going to report earnings on Friday, and they typically set the tone for earnings season, providing some key insights into the health of our economy. Now, corporations and everyday consumers rely heavily on banks. So hearing from the CEOs about their balance sheets, their outlook, and really their near-term risks that they see is immensely valuable. Now, analysts are expecting the financial sector to report a year-over-year earnings decline. And specifically, the banking industry is projected to see a decline of 12% in earnings. Now, this decline is largely driven by challenges in areas like investment banking, where M&A activity continues to struggle due to elevated interest rates and, just financing deals are just more expensive. Now, it's not all bleak. Certain elements of the banking industry are showing some strength. For example, wealth management, asset management, those areas are performing quite well because the stock market's done so well. In the last quarter, the S&P 500 is up 5.5%. So this has proved to be a tailwind for banks with significant exposure to these areas. Now, what's particularly interesting is the outlook moving forward. So with the Federal Reserve, beginning to cut interest rates, right? We saw a 50 basis point cut in September. There's some talks about some more cuts in November and possibly December as well. The key interest rate for the Federal Reserve right now is 4.8%, and we'll be moving towards potentially a neutral stance of about 3%. Now, there's optimism that investment banking, for example, and overall M&A activity will pick up as we enter a lower rate environment, and this could potentially reverse some of the negative trends we're seeing in the banking industry. Now, shifting gears to information technology, which continues to be a powerhouse this earnings season. Despite analysts lowering their earnings per share estimates for quarter three by 3.9%, which is more than the 5-year and 10-year averages, the tech sector is expected to report the highest year-over-year earnings growth of all 11 sectors at 15.2%. Now, of course, leading the charge is Nvidia, which it's projected to significantly boost the sector's earnings with an earnings per share increase from 40 cents a share to 74 cents. And to put this into perspective, if you take out Nvidia, the sector's growth rate drops to 7.9% from just over 15%. That's pretty huge. And so similarly, if we look at Meta and Alphabet, they're expected to post strong earnings growth as well. Meta's earnings per share is projected to rise from $4.39 a share to $5.19. And Alphabet, formerly known as Google, their earnings share is expected to rise from $1.55 a share to $1.83. And so last quarter, even though many mega cap tech companies reported some strong earnings, their cautious guidance didn't really meet investors' expectations, which led to a pullback in the sector. However, if these companies outperform their tempered expectations, we could see a significant rally in tech stocks. The technology sector is not only expected to contribute the most to the S&P 500's overall growth, but it's also one of the only 3 sectors projected to report double digits earnings growth. So now I believe this earnings season will reignite the AI frenzy. It did take a bit of a pause over the last few months, but companies are making some massive investments in artificial intelligence, and we can expect to hear a lot about this during the earnings calls. And this focus on AI could not only boost individual companies, but also have a positive ripple effect across the entire sector. So, in summary, as we kick off earnings season, all eyes are on the banks to set the tone. While challenges remain, especially in investment banking, the potential for a turnaround is on the horizon as interest rates start to decline. And meanwhile, the tech sector continues to show robust growth, and I think positive surprises here could drive the market forward. Now, let's shift our focus to an important development affecting many of us directly, which is a sharp decline in high yield savings account rates. So, since the Federal Reserve cut interest rates by 50 basis points, we've seen a noticeable drop in yields. This is something I've talked about in previous episodes. Now, this was really what we're seeing is an intended effect of the Federal Reserve's rate cuts. But if we look at some of the high yield savings rates at some of the major providers, I do expect that the trend is going to continue as the Fed continues to cut rates in November and possibly December as well. Like, for example, if you look at interest rates from Marcus by Goldman Sachs, it's now at 4.25%, down from just over 5% a couple months ago. American Express and Capital One have lowered their rates to 4.1%. So we're witnessing, similar declines in money market funds too. Those have dipped below 5% recently after being at, over 5%, as high as almost 5.5%, depending on certain money market funds. So it's important to note that the money market category itself has ballooned from $3.3 trillion at the end of 2018 to over $6.5 trillion today. Now, I believe, this sets a stage for a significant shift in the market. As yields on high yield savings and money markets continue to decline, I think that investors will start to look at other investment categories with more attractive return profiles. Now, remember, unless explicitly stated, due to like a special promotion, your high yield savings account yield typically drops without much notice. So after a few more rate cuts, you might find yourself in a high yield savings account paying around 3%. In that scenario, opportunities in the stock market, the bond market, or other areas such as alternative investments could look more appealing. Now, consider this, when high yield savings rates were at 5%, keeping funds in a savings account might have seemed like an attractive investment, especially for risk averse investors, maybe comparing to like a conservative portfolio. But now, as we near the end of 2024, the S&P 500 is up 21%. Bonds with some duration are nearing double-digit returns, and alternative investment strategies like private credit, for example, they're offering returns in the 10% space. So you might be thinking, I should have invested that cash instead. But, hindsight's always 20/20, and this really underscores the importance of proactive financial planning. This is why I recommend meeting with a certified financial planner who can take the time to understand what your goals are and recommend an investment approach that's really aligned with your objectives and capitalize on some of these market opportunities. And for Wealthstone clients, we spent much of the year deploying money market funds into the market, whether that was in stocks or bonds or alternatives. My goal was to get the cash invested. And as we head into 2025, with the backdrop of further rate cuts, optimism around technology and AI, and what seems to be a soft landing scenario, I'm feeling good about our positioning in portfolios. And this is what I've been sharing with clients during review calls and also in my monthly market outlook that I send out to all clients. So for some of you, maintaining a large cash allocation might make sense, especially if you have an upcoming cash need. But, if a significant portion of your portfolio is in high yield savings or money market funds, it might be time to start discussing, creating a long-term investment strategy with a professional. So, and keep in mind, with bank savings accounts, they're typically FDIC insured up to certain limits, while investments in stocks, bonds, or alternatives are typically not. And so understanding the differences in risk, it's crucial to making informed decisions and investing appropriately. So this concludes this week's episode of Money Minutes. Please reach out with any questions or to discuss your personal situation. Thank you so much for tuning in.